Hello, everybody, and welcome to another session of Accounting 101. My name is Dr. Churchill, and I'm happy to have you here with me again. Today, we're going to continue to talk about the accounting cycle. We've gone through all the steps of the accounting cycle, and we're finally ready to do the very last step, which is closing the books. So, what are we going to be learning about? First of all, we're going to review the accounting cycle, talk about the purpose of the closing process, the steps of the closing process, and the post-closing trial balance. So, as a review, let's look back at the steps of the accounting cycle that we've been covering the last few sessions. The very first step, if you remember, is to identify transactions. Transactions basically are just anything that the business does. And this business, depending on its size, can have hundreds, thousands, even millions of transactions. And these transactions occur every day. They can be anything from purchasing supplies, paying expenses, paying their employees, selling goods or services. All of those are considered transactions. And it all starts with you identifying an action as a transaction. The second step is to record the journal entries. Now, when we record the journal entries, we're simply writing down what happened in those transactions. And if you recall, we use debits and credits to record those transactions. Just a little reminder, debits and credits can be confusing, but as we said before, debit simply means left and credit simply means right. Depending on the type of account, will tell you if you're going to debit or credit it to increase or decrease it. After you have recorded the journal entries, you're going to post the journal entries to the general ledger. The general ledger is a record of all the transactions that affect a certain account. So, for example, all the transactions that affected cash, they are going to be listed in the general ledger account for cash. The debits and the credits are all going to be put in there, and then the ending balance is going to be kept up and it's going to be readily available to you to be able to tell the balance in that cash account or for any other account because all of them are going to have their general ledger account. Step number four is to create the unadjusted trial balance. The unadjusted trial balance is a list of all the accounts in your general ledger and their balance in two columns, debit column to the left, credit column to the right. You're going to enter all of those in, and at the very bottom, they should equal each other because remember, debits always have to equal credits. If they don't equal each other, you know you did a mistake somewhere, and you get the fun job of going back through and trying to figure out what you did wrong. Step number five is analyze the worksheet. The worksheet is simply a document that is used during the closing process and the creation of the financial statements for the company. Step five is the adjusting entries. Remember the discussion that we had on accruals and deferrals? That's when we do the adjusting entries. Accruals and deferrals are going to require those entries at the end of the period, usually at the end of the year. Step seven, create the financial statements. I like to think of the financial statements as a culmination of all the work that you do during the period, during the year, the month, the quarter. And this is your final presentation to investors, managers, people inside and outside of the company to look at and to be able to tell the financial health of the company and what they've been up to over the past year. After you've created the financial statements, it's time for the closing process. And that's what we're going to talk about next. So what is the purpose of the closing process? Well, to understand the purpose, you first need to understand the difference between temporary accounts and permanent accounts. Now, a temporary account is a short-term account that is used for a specific time period and is zeroed out at the end of each period. It can also be known as nominal accounts. You'll see it called that occasionally. Examples include revenues, expenses, and dividends. Permanent accounts are accounts pretty much just the opposite. Their balances are not zeroed out and they are carried over from one accounting period to the next. And those are also sometimes called real accounts. Examples include assets, liabilities, and equity. And something that you might have noticed, revenues, expenses, and dividends are accounts that show up on the income statement. Assets, liabilities, and equity are accounts that show up on the balance sheet. So why are some accounts permanent and some accounts temporary? So first of all, temporary accounts give information on a specific time period. Permanent accounts show ongoing progress for a company. Let's look at an example together to be able to kind of figure out what exactly we're talking about here. And we're going to use the example of Don's Flag Outlet. Don's Flag Outlet sells American flags. During the month of May, Dawn sells a lot of flags. She sells and sells and sells. She sells $50,000 worth of flags. Now, May is Memorial Day, and Memorial Day is when people typically purchase flags. If you go into Walmart, Costco, Sam's Club, stores like that, you suddenly see American flags popping up for sale. So you sell a lot of those flags in May. June, not so much. It's a slower month for sales for flags, only $10,000 worth of flags sold. So to be able to understand why we closed out these accounts, let's see what happens when we don't close out these accounts. Revenue account not closed out, June would show $60,000 of revenue. That's because that $50,000 from May would carry over into June and you add them together. Now, the managers of the company aren't going to know that May is their big month for flag sales because it's combined with June. They need to know about May because they need to make sure their inventory balances, their supplies of the stores, their employees are all geared up to create and sell more flags. June, they can scale back their operations. If the revenue account is closed out, therefore, June would show the $10,000 in revenue and May would show $50,000 in revenue. Another way I like to look at permanent and temporary accounts is in terms of sports, basketball, baseball, any kind of sport, really. Temporary accounts, think of them as the score during one game. You have the ending score, and then you go on to the next game with everybody at zero. Permanent accounts, think of that as the stats for the players or the team. Those are kept over the entire season, game to game to game, and they're added together. That's a little bit how permanent and temporary accounts are like. Now that we have an understanding of those accounts, let's actually go through the closing process. And it is a four-step process. Step number one, close the revenue accounts to the income summary. We're going to look at Don's Flag Outlet again, and we're just going to look at one revenue account to make it simple. But keep in mind, you can do this with all the revenue accounts. The process is still the same. We have a $50,000 balance in the flag revenue account. And we're using a T account here, and you remember on a T account, on the right-hand side is the credit side. Revenue accounts have a credit balance. We want to get the balance in that revenue account down to zero. And as we've learned, the way to reduce an account is if it has a credit, you debit it. If it has a debit balance, you credit it. In this case, we're going to debit flag revenue, $50,000. That gives you a $0 balance. We have closed out the revenue account. But keep in mind, if you have a debit, you need to have at least one credit, and vice versa. If there's a credit, you need a debit. So where do we credit this? Well, we're going to use an account called the income summary. This is another temporary account. It only shows up during the closing process, and after the closing process is done, it disappears and goes away, and we don't have to worry about it until the next closing process. What we'll do is we'll credit income summary for that $50,000. The way it looks for our journal entries is we debit flag revenue $50,000, credit income summary $50,000. Now on to step two. We're going to close the expense accounts to the income summary. And for simplicity's sake, we're going to only have one expense account called flag expenses. Expense accounts have a debit balance, so we have a debit balance of $35,000. To get it to zero, we will credit it $35,000. We have our $0 balance now, and we will debit income summary $35,000. This is what the journal entry will look like. Debit income summary $35,000. Credit flag expenses $35,000. Now on to step three, closing the income summary to retained earnings. We want to get rid of the income summary. We have no use for it anymore. So what we're going to do is we're going to debit it $15,000. 35, the difference between 35,000 and 50,000 is 15, so we will therefore debit it $15,000. When we do that, we now have a balance of $0. Retained earnings will then be credited for $15,000. And our journal entry will look like this. Debit income summary, $15,000. Credit retained earnings, $15,000. Now, something that I want to point out to you, remember the difference between revenue and expenses is net income. Revenue minus expenses equals $15,000 of net income. We have effectively moved the net income over to the retained earnings account, and that's going to line up with a statement of retained earnings that shows $15,000 increase from net income. And the very last step is close dividends account to retained earnings. To be able to zero out that account, we're going to debit retained earnings for the amount of the dividends. We have $5,000, I'm sorry, not debit, we're going to credit retained earnings for the amount of the dividends. Dividends has a $5,000 debit. We will therefore credit that account to get it to zero and debit retained earnings $5,000. Our journal entry looks like this. Debit retained earnings $5,000, credit dividends $5,000. After we've done the closing process, we will create the post-closing trial balance. First of all, over here on the left, we have the adjusted trial balance. This is before the closing process. And just as a little review, we have our asset accounts here with their debit balances, our credit accounts with their credit balances, stock and revenue, which are part of owner's equity. They're going to be on the right in their credit balance. And expenses and dividends will be on the left in the debit balance, and then retained earnings on the right in the credit balance of $5,000. You see here, they equal each other. Debits and credits have to equal each other, and they do. After the closing process, everything looks the same except revenue, expenses, and dividends now have zero balances. And the retained earnings account now has $15,000. That is calculated by a $5,000 beginning balance, which we see over here on the adjusted trial balance, plus $50,000 in revenue, minus $35,000 in flag expenses, minus $5,000 dividends, gives us an ending balance of $15,000. That is all for the closing process. You have now completed the accounting cycle. If you have any questions, feel free to shoot me an email and I'm happy to help you. I'll see you next time.